My name is Chris Conway. Not so long ago, income investing was relatively straightforward. Buy a handful of dividend-paying blue chips, some government bonds or term deposits, and you were all set. Today, the landscape looks vastly different because there's way more options all up and down the risk-return spectrum. So, how should you invest for income today? Well, to answer that question, we've assembled an all-star panel. Dr. Don Hamson from Plato, Dylan Burke from Kapstream, and Craig Schloeffel from HMC Private Credit. Gents, welcome.
Thank you.
Thank you.
Let's start with the big picture. Don, I'm going to come to you first. What are the most important factors influencing your ability to generate income, and how have they changed over the last 12 months?
Well, I think the challenge for income out of equity now is that equity markets are all-time high. Dividends in Australia have actually gone backwards for the last couple of years. So yields are actually pretty much at an all-time low. Australian markets like yielding about 1% lower than it was sort of 12 months ago. Yeah, the classic of that is Commonwealth Bank on sub 4% gross yield. So that's the challenge, I think, for equity markets is they've risen in front of the interest rate falls and yields are very low.
Yep. Dylan, what about you in the bond space?
Well, we're fortunate in the bond space because yields are not now near their lows. They're still quite high. So, in investment grade bonds, you can still get 5.4% yield to maturity, which is pretty attractive. And it's gone down a little bit, like maybe 50 basis points or so over the last year. But in the context of living through zero yield worlds, I think we can all agree that looks pretty good.
Craig, what about you? Most important factors in the private credit space?
Yeah, private credit's a little bit different in that we're uncorrelated to many markets. And so we haven't seen interest rate fluctuations affect our market so much. Certainly as interest rates come off, yields in our space will tighten up a little bit. But mainly what we've seen is because of the significant interest in private credit, it's that inflow of capital which has started to put a little bit of constraint on spreads.
All right, let's shift gears, gentlemen. We've just heard about the big picture forces. Now I want to zoom in. You each play on a different part of the income spectrum, so we'll take a closer look at your unique approaches. Don, Plato, how does Plato aim to deliver sustainable yield in a world where, as you were talking about earlier, dividends can be cut, franking credits shift, and equity markets are full and volatile?
You've got to be active. That's the first thing. You can't just have a set and forget portfolio. As you said, you can't just buy a couple of blue chips and expect to get a great yield. You're not going to get a great yield out of Combank. So we're very active. We try and avoid the stocks that are cutting their dividends, and the Australian market's quite cyclical. About 20% of stocks cut their dividends each year. It's probably slightly elevated at the moment, given we've gone through a higher interest rate cycle and commodity prices are coming down. So yeah, it's just important to be active, and we also trade around dividend events. We're not a long-term, this is a great stock for 5 years, because in the current environment, who knows what Trump's going to say tomorrow, and that could have havoc on all sorts of sectors.
Yep. Don, so whilst yields have come down, or the overall yield of the market has come down, are dividends still as dependable as they always have been?
Well, at the market level they are. I think that's the issue, is you're still getting 4.5% gross yield. I always look at gross yield, and we're delivering like almost 3% more than that. So the yield is still there, but you've got to be, I think, smarter the way that you move around and avoid those dividend traps. So it's important, I think, to be active and vigilant.
Yep. Dylan, Kapstream focuses on high quality credit and actively managed bond portfolios. How have you adapted to the new or changing rate regime, and what's the biggest challenge at the moment?
As Don mentioned, you've got to be very active right now. Obviously in 2022, rates backed up very hard, and that caused capital losses in fixed income. So in that environment, we cut our exposure to interest rates significantly, close to zero. And then as interest rates have gone up and fixed income starting to look good again, we've added interest rate sensitivity, which means that we've benefited as rates have started to come down a bit. The other thing we've sort of done is we've built in a fair bit of yield into the portfolio. We've got a fair bit of credit spread in there. And you've just got to be very globally active. You have to find the best markets. You've got to get the best RV that you can get globally. So in Australia right now, credit spreads are around the long run average, which is very attractive, whereas most other risk assets are close to all-time highs, whether they're equities, US credit spreads, and so forth. And so we're focusing on the Australian credit spreads where it's better value, and then globally in terms of rates, we're picking those markets where they're cutting rates first and hardest, whether it's in Canada or Europe or New Zealand. You can't just be focused on just Australia, for instance. You've got to go where they cut hardest and fastest.
Yep. Dylan, bonds often considered the safe part of a portfolio. Are they attractive again?
I think they're very attractive. They obviously suffered in 2022 when interest rates in the US increased, almost 500 basis points, and in Australia, almost 400 basis points. But that's done. We're now on the other path. Inflation's sort of stable-ish here, and rates are starting to come down globally. So there's a bit of capital appreciation that can be had in bonds here. So look, I don't think we're going to go back to the zero interest rate world we used to have, but nevertheless, I just think with the very high coupon, it's a very attractive place to be right now.
Yep. Craig, private credit, been getting a lot of attention, some of it skeptical. How do you balance transparency and risk whilst still targeting attractive yields?
Yeah, that's a great question. And private credit, I think what's often forgotten is private credit is a huge asset class. It's everything from real estate backed right through to corporate and asset finance, as well as structured credit. But if I look at the area that we're mainly focused on, which is the commercial real estate backed credit, it can be very transparent because often you can drive past and have a look at what's going on at the property, and you can't get more transparent than that. But further to that, there's been a lot of noise around regulation, and we'd welcome a little bit of regulation into our space. We think that having some barriers to entry and minimum standards would elevate, to your point, the level of transparency across the private credit market. I think there will certainly come some balances via regulation, but equally, in terms of balancing risk, our fund, for instance, is over 80% in the residential asset class, and structurally in Australia we have an undersupply. So I think, if you hone in on the right part of the private credit spectrum, for us it's residential real estate, I think you can really ride that unfortunate undersupply of housing and not only buy into that, but help to deliver some of this housing as well.
Craig, just more broadly, what makes private credit a viable income alternative against the more traditional asset classes?
Yeah, I think exactly getting back to that, we're different in the sense that in the commercial real estate debt space, we've got hard assets behind all of our debt that we write. So the adage that, some traditional asset classes can go to zero, ours can't, because we've got a physical property that is backing the mortgage that we're writing. So traditional asset classes, certainly not saying they're not a great place to be, but private credit as an alternative and uncorrelated to many markets is a great place for investors to consider as well.
Yep. All right, gents, let's shift gears again. Risks and opportunities into the rest of 2025 and of course into 2026. We've seen a great snapshot of your different approaches, but of course return doesn't come without risk. Craig, what's the most important risk income-focused investors might be overlooking right now?
Yeah, it's a good question. In the property space, I think, again, it's so transparent because you can drive past and see it. But in terms of risk, what we saw during COVID was that supply chain disruption around the world, which really put a handbrake on a lot of construction companies because they just couldn't get the supply that they needed to complete. That meant increase in timelines, and of course, increase in time meant increase in cost. And we saw a lot of builders struggle through that period. Some unfortunately went into liquidation. So what we don't understand right now with geopolitics around the world is what will be the disruption to physical goods. The only thing I'd counter that with is back when we saw those disruptions, many companies operated on a just-in-time in terms of stock, and now we're seeing many companies work on a just-in-case. And so suppliers have been building up supply largely to mitigate that risk, but certainly we just don't know right now what's going to happen with supply trade. I'd say that builders are very wary of it, and that's what we're watching.
Dylan, in your space, in the bond space, most important risk for investors?
I think for us, it's living in a Trump 2.0 world, waking up to X or truth posts that move the market significantly. Take April as an example, where equities fell almost 20% down from the peak to the bottom. That level of macro volatility is significantly higher in this environment. And I think it's fairly unpredictable. And so as a fixed income investor, we're fortunate that we can just look out a few years to the maturity of our bonds and go, are we going to get paid back from this investment grade company? And if the answer is yes, we'll clip the coupon and we'll laugh all the way to the bank. Whereas I think sometimes in other asset classes, it's just very difficult to pick that. And in this environment, I would argue many people can't pick that because it's just whatever Trump thinks on a day-to-day basis.
Yep. Don, same question for you. What's the biggest risk that you're wrestling with?
Well, I think it is Trump. I mean, if you look at the first 6 months of this year, it's all been Trump, tariffs, Liberation Day. Is he going to bomb Iran or what have you? Markets are all over the shop, but which is why you need a diversified portfolio. We have close to 100 stocks, so I think that's one way. The other one I alluded to before is, you haven't got valuation on your side in the Australian market at the moment, and particularly in the Commonwealth Bank's classics, 30 times PE, less than 4% gross yield, only about 2.5% cash yield. I know it's come back a bit in the last week or two, but it still looks pretty expensive. And so I think there's a lot of retail investors that are still sitting on this CommBank. They've got a great return, but I think the risk could be that, it goes back to $100 and, they're going to lose 2 years of return.
Let's flip the script now. Gents, we'll focus on the opportunities. Again, Don, I'll come back to you first. What's the biggest opportunity that you think in your space over the next 12?
So despite what I said, the reality is if you can trade your portfolio, you can still get great yield. You can even get great yield out of Commonwealth Bank because like final dividend, we might get about a 2% gross yield out of the final dividend from CommBank. We don't have to hold it for a year to get that. We only have to hold it maybe 2 months. And if you think I can get 2% in 2 months, that's annualized 12%. So, and that's how we trade our portfolio around dividend events. So I think that's even more important now given that the yields of the market are so low that you need to be very active to get that. So I think that's the greatest opportunity.
Just one for people playing at home because it sounds like a compelling strategy, but it's not easy to do, is it?
Well, that's why I did say before you need a diversified portfolio, right? You just put everything on CommBank, they come out and have a bad result, or heaven forbid Matt Coman, sort of says that's it, and they replace him with who knows what. There are risks, and that's why we run 100 stocks, not one stock. And so, yeah, you're right. You need to do it in a very refined manner, and diversification is your friend.
Dylan, what about you? What's the biggest opportunity you think in your space over 12 months?
The biggest opportunity is, well, obviously the credit spreads are quite attractive in Australia still, so there'll be a bit of probably catch up to other countries and you'll get a bit of capital gains. And the other element of that market that adds to that opportunity set is there's a lot of new investors in that space that don't get good allocations in public deals. And so that means that if you're a large participant, you have the opportunity to participate in those hot issues, and they often trade above par on the following days or weeks, and so that gives you an opportunity to also make further capital gains. So Aussie credit right now to me looks very attractive, and those two elements add to that opportunity.
Craig, bring us home. What's the biggest opportunity in the private credit space?
Yeah, I think private credit's still an asset class that people are discovering. So for many people, there's a huge opportunity in diversifying and having a bit of private credit within their portfolio. But secondly, that I'd say funds that are focused on commercial real estate, and particularly the residential asset class like ourselves, looking at a fund where you're getting large diversity across the residential asset class, there's huge opportunity because, as we know, structurally in this country, there's an undersupply of residential housing. So not only do you get to participate in helping to build out some of that housing, the opportunity to provide that credit, which the banks simply can't because of regulation and their ability to participate across the market, is a huge opportunity for income investors.
Yeah. All right, gentlemen, we're going to have a little bit of fun. Take the gloves off. Here we go. So I genuinely have just inherited some money. I won't tell you how much it is, but it's not retirement money, but it is hurt money in the sense that it would hurt if I lost it. So for the sake of the conversation, we'll call it $100,000. Now, I don't want to put it in crypto, and I don't want to put it in the bank earning next to nothing. So I want to invest it for income. And I'm sitting across from three gents who think that they can each do the job better than each other. So here's the challenge. 60 seconds to pitch why I should give you the money as opposed to your fellow panelists. Craig, take us away.
Well, I'll start by highlighting that markets around the world are near or at all-time high, and being uncorrelated to markets, if there is a market shock, we're going to protect you on the downside there, being uncorrelated to that. Secondly, I'd say we've got hard assets behind what you invest in, being commercial real estate, particularly with our fund in the residential sector. And if you come into something like our pool fund, which has first mortgage only, 60 different mortgages, you can get real diversity across the country, asset class, duration and borrower, for what we think are fantastic risk-adjusted returns. And, we like to think about the pool fund offering something like a set and forget. So that money today is $100,000. You can give it to me, and in a couple of years come back, and I think you'll be very pleased with what it's doing. And we think the risk and return profile there is fantastic.
Pretty compelling. Dylan?
Investment grade credit right now, short dated, you can look at our various funds. Essentially daily liquid, you can change your mind. So you see another opportunity somewhere else, you can sell it and you'll still make a good return. We're close to decade high levels in yield still. And so looking forward for an investment grade, sleep at night portfolio, 18 years track record, no defaults. And if there's more liberation days, you'll be sleeping slightly at night. And if you really want to switch into riskier stuff, you can do that too. So I think it's a good spot to be.
Also pretty compelling. Don, bring us home.
Well, you can have your cake and eat it too with equity, because not only do you get good income and great franking credits, but you can also get some capital growth. We've got a 14-year track record of delivering nearly 12% return, 9% income as part of that, so you're getting nearly 3% capital growth. So I think equities is the one area that you can keep up with inflation, because earnings will grow over time, but you can get some very good income, and those franking credits to me are the icing on the cake.
Thank you, gentlemen. I'm not sure I've made a decision, but I know I'm not putting it in crypto. So thank you very much for that. A huge thanks to our panelists, Don, Dylan, and Craig. If you enjoyed that interview, make sure to give it a like, and don't forget to check out the rest of the Income Series content available on the Livewire Markets website. Until next time, take care.